Welcome. My name is Kavita Rao. I work with the National Institute of Public Finance and Policy. I'm being asked to chair this session, so I'll keep my interventions to the minimum. But I guess this is a very exciting time to be talking about international tax. Given the last 10 years, I guess, have been interesting, but things keep happening in fits and spurts, and we seem to be getting some noise on common minimum tax and stuff like that. So, and whether there should be different ways of looking at the tax system in order to ensure better compliance seems to be the overriding theme, both with the papers and in the general discussion. So I welcome you all to this session, and we'll start with the first paper. Ms. Francois,
Yes.
would you like to start?
Yes.
We hope to have in total an hour and 40 minutes. So I'm hoping to keep presentations to about about 15 minutes each. So that will give us a little time to get the discussants in as well, and if there are any questions.
Okay, perfect.
Right.
Can you see my screen?
We can see your screen, yes.
Okay, perfect. So thank you for having me to this conference, and thank you, Johannes, for accepting to discuss the paper. So I'm going to talk about profit shifting and what kind of tax principle we should use regarding international corporate taxation. So I'm going to focus on multinational firms here, and we know that multinational firms choose where they want to locate their profit so that they can reduce their tax liability. And these multinational firms are subject to a tax policy, and what I'm going to call here a tax policy will be composed of a tax system, and this tax system can be either source-based or destination-based. So source-based is basically what we have now, where profits are taxed in the countries where goods are produced. But we could also move to a destination-based tax system, where profits would be taxed in the country of where the good would be sold. Those firms, they're also going to be facing a statutory tax rate, which is basically the tax rate that we hear of. I'm not going to focus here on any effective tax rate. And last, I will the firm will face a tax enforcement level, which is basically how much countries are willing to control for profit shifting. So how much effort they're willing to make so that firms don't shift profit abroad. What we know is that destination-based taxes are considered optimal in most of the literature. But what we observe is that countries all use source-based corporate taxation, which can be a little bit puzzling, because if destination-based taxes are optimal, then why are we all using such a suboptimal tax system? And this is basically true worldwide. So what I'm trying here in this paper is that I'm endogenizing 3 levels. So the tax rate and the tax enforcement response of governments and the profit shifting response of firms, so that I can try to investigate under what conditions source-based taxes are in equilibrium, and under which condition destination-based taxes are in equilibrium. So I will build a tax competition model with endogenous transfer pricing, where I focus on the equilibrium choice between source-based and destination-based taxes in terms of tax revenues only. So I won't have any welfare function or anything. I'm just assuming that my governments want to maximize their tax revenue while taking into account other countries' tax policy responses. So in the vein of what's been done a little bit recently, yeah, this is closely related to some of Johannes' work. So I'm introducing so endogenous tax rate and tax enforcement level, so that I can actually know the in equilibrium how countries should behave. So just to give you an idea of what I'm going to show you, the paper first allows to derive some results regarding tax competition. And what I find is the usual result on source-based taxation, which is that if we all use source-based taxation, we're all going to compete on statutory tax rate, which is going to lead to a race to the bottom with tax rates that are going to be low. If some countries start to use destination-based taxes, you can still have some competition, but this tax competition is going to disappear if all countries decide to use source-based taxation, which is basically the advantage that has been talked about when the introduction of destination-based taxes was discussed in the US in 2016. But this is a strong assumption because we need all countries to actually use destination-based taxes. Since I'm introducing endogenous profit shifting monitoring, I can derive how countries should behave regarding profit shifting. And I will show you that a country using source-based taxation will require to strictly monitor profit shifting to avoid this race to the bottom, while a country unilaterally moving to destination-based taxes will have an incentive to let firm shift profits. And finally, regarding the most important question of the paper, countries should use source-based taxation where corporate revenues are quite large. I'll explain to you a little bit further why. While destination-based taxes should be implemented when corporate revenues are quite small. And there's an area for average or intermediate level of corporate revenues where we have multiple equilibria, so both source-based and destination-based taxes coexist. But I don't find any unilateral equilibrium, so I don't find any situation where one country has an incentive to adopt destination-based taxes while the other one should keep on using source-based taxes, which is in line with the intuition that was developed, for example, by the Oxford researcher that worked on destination-based taxes. So just quickly on the model, it's a quite simple model with two countries, and each country is endowed with one multinational firm. So for example, if I'm taking the home country will have one parent firm, and this home firm would have an affiliate in the foreign country, and conversely, the foreign multinational firm would have its parent firm in foreign and its affiliate in home. And I have an extension in the paper with many firms. I'll show, and basically the results are robust to that kind of extension. The government will choose their tax systems, or either source-based or destination-based taxes, and they will decide on their tax rate taux and their enforcement level, which I'm calling alpha, which I consider as a probability of detection by the tax authority. And this probability will be between 100 bar alpha and 1, so strictly positive. Firms produce an input in their affiliate, and they sell this input to their parent firm in the other country, and the parent then generates a revenue that I'm going to call pi. I'll show you the profit function in a second, but just the arm's length principle has to be applied. So firms can deviate, their transfer price can deviate from the marginal cost. So here, the transfer price Q can deviate from the marginal cost C that I'm setting to 0. But if they do so, the multinational firm has to pay a concealment cost, which is alpha Q squared. So this cost is just increasing in the deviation and the probability of detection, which is quite, which is what's being used in in corporate taxation to account for the behavior of firms. So basically what the profit function looks like is the following. The firm, the black part here is the profit of the parent firm. So if I'm in the home, the parent is in home, so it's going to be taxed at rate tau on its revenue pi minus its cost q, because it has imported the input, so it can be deducted as a cost. Then this blue part here is the profit of the affiliate in the foreign country. So it generates a profit Q, which is going to be taxed at rate tau star only if the foreign country uses source-based taxation. If the foreign country uses destination-based taxes, then the input is produced in foreign, but then it is sold in home, so it won't be taxed in foreign. Which is why I have an S star here, which is just a dummy equal to 1 if foreign uses source-based taxes. The red square, the red term here is the border tax adjustment. It's again the same idea. When the input is being transferred to the home country, it will be taxed by the home country at rate tau if home uses destination-based taxes, because then you have an input that is being sold in foreign, so it will necessarily be taxed, and then you have the concealment cost. So firms maximize this profit function with respect to their transfer price, and this thanks to that we can derive then best response tax rates, and we observe that when both countries use the source principle, profits are going to be transferred to the low tax country, which is what we observe currently, which leads to a race to the bottom. If then home decides to move to destination-based taxes unilaterally while foreigners keep on using source-based taxes, then profits are going to be shifted towards home, so towards the destination-based country. This destination-based country is going to behave as a sort of tax haven because it will attract profit no matter its tax rate here, which changes a little bit the shape of tax competition. And then if we all use destination-based taxes, there is no profit shifting, so firms necessarily comply with the arm's length principle. Then I have the behavior of the governments. So the governments are going to maximize their tax revenue T with respect to both their tax rate and their tax enforcement level, subject to profit condition, which is basically I'm considering territorial taxation. I won't go into the detail here, but they basically just want to maximize their tax revenue. In order to maximize their tax revenue, what we find is that if they want to use source-based taxation, they should implement a strict enforcement. So they should set the probability of detection to 1, which does not mean that there is no profit shifting in equilibrium, just that the benefit of for the firm, the benefit of shifting profit can still be higher than the concealment cost, but still the cost is quite high, and for governments it's quite interesting to set such a high enforcement level because they can then limit profit shifting and then set higher tax rates without having all the profit of the firm being shifted out of their country. If a country decides to unilaterally use destination-based taxes, then it's going to set a loose control of profit shifting and set the enforcement level to its lower bound under bar alpha, because as I said, it's going to behave as a tax haven, so it will attract profit, and then it has no incentive to control for profit shifting. And then since there's no tax competition under a universal use of the destination principle, then we can let alpha being basically anything, and it won't change the behavior of the firm. this is obviously related to the assumption I make on the enforcement level, because I don't have any cost for profit shifting monitoring, which makes much more sense that a country has an incentive to set alpha equal to 1 under source-based taxation. Now, regarding what we should choose in terms of tax system. So I'm show you first the best response to the source principle. So if the foreign country uses source-based taxes, what should we use? So I compute the tax revenue difference. So this is this long equation. This is basically the equation of an ellipse. So I'm showing you the ellipse just below here. This is the best response of the home country. I'm assuming that under bar alpha, so my lower bound is 0.01, so quite close to 0. And we see that destination-based taxes are a best response to the source principle only if pi and pi star are quite low. So if the revenue generated by the firms are not too important, mostly because this is very costly for a country to move to destination-based taxes if the foreign firms generate large revenue, because then they won't be able to tax it. If you use destination-based taxes, you're only taxing your domestic firms. So if pi is large, then you're missing out on all this profit. This is the best response of both the home and the foreign country. So you observe that in the right area, basically, both countries decide to use source-based taxes as the best response. So source-based will be part of a nice equilibrium. And here, when one country uses source-based taxes and you want to maybe use destination-based taxes or the reverse, so we're going to have to move on to the best response to the destination principle. But we observe that you want to use source-based taxes when corporate revenues are large, both domestic and foreign. But then one intuition was, when we first started to talk about destination-based taxes, was if one country decides to use destination-based taxes, then all countries will have incentive to move to destination-based taxes too. And this is basically what we're looking at here. So I have a tax revenue difference that I didn't compute, but I'm showing you when a country is indifferent between both tax principle. This is represented by a line. To the left of the line, I decide to use destination-based taxes. To the right of the line, I use source-based taxes. So now this only depends on the level of revenue of my own firms. So when they generate large revenue, I use source-based taxes. When they generate low revenue, I use destination-based taxes. This is again related to whether or not I get to tax my own firm and foreign firm. And this is also related to the level of my tax rate in equilibrium that depend on pi and pi star. So yeah, I'm going to again have an area where here for small level of profits, all countries are going to decide to use destination-based taxes, and this will again be part of a sub-gain Nash equilibrium. So you use source-based taxes when corporate revenues are large. You use destination-based taxes when corporate revenues are low, but you still have now an area where both tax principles coexist. So as I said in the introduction, you don't have any unilateral equilibrium in the end. So the last thing I'm doing here is that I'm investigating the basically tax ranking of equilibrium when we are in the green area. Whether in this case we should use source-based or destination-based taxes. So I'm again computing the tax revenue difference between both two systems. If we look at just the green area, this difference represents again an ellipse, which is the little black ellipse in the bottom left corner here. And we see that this ellipse never crosses and goes into the green area. And above the ellipse anyway is the domination of the source principle. So what I find here, and which is quite opposed, what we find with the literature is that the source principle actually yields more revenue than the destination principle, and that basically we should almost always use source-based taxes, and destination-based taxes is just an equilibrium for very, very low level of corporate revenues. So I think slightly over time. So if we needed to remember something specific from the paper is that there is no unilateral equilibrium. So if one country decides to move on to destination-based taxes for some reason, then we would all shift to a new equilibrium where we all use destination-based taxes. But what I show here is that source-based taxes technically yield more revenue, but this is very specific to the fact that I have a strict enforcement under source-based taxation. There is an extension in the paper where I loosen this assumption and I assume that the enforcement level is fixed, so I can decide at which level I set it. But the results are still quite robust to this assumption. So basically, we're in an equilibrium situation, and this sort of rationalizes the fact that we're all using source-based taxes. Okay, thank you.
Thank you very much. Very interesting paper. I'll request Dr. Becker to give his discussant's remarks before we open the floor to questions.
Okay. Thanks. Can you see that?
Yes.
Yeah.
Yeah. So thank you for the presentation. I think I skipped the summary and come directly to my assessment. I think this is a very interesting, thoroughly crafted paper. It's quite mature yet, and it's a very topical question with everything that's going on the international level, right? So my comments will be, I will focus on the question actually rather than the answer, and ask whether the question is rightly stated, and then I'll ask whether this is the genuine trade-off between a source-based destination-based system, and then I have a proposal to make the paper even more interesting. Right? Good. So this is maybe the most important comment. So in many of the papers, and starting with the Our Back Endeavor paper, the whole question is framed as an either-or, right? So either I have a source-based system or I have a destination-based system. And I think this is starting with Daniel Shaviro, who wrote a very nice, well, mean paper, if you will, on the destination-based cash flow tax. And this is one of his tweets where he said, I took down BCFT as a flawed and misleading intellectual frame. This is, of course, always a little bit overstated. So this paper is written with that, but here it says that, for example, origin-based corporate tax versus VAT isn't actually an either-or. And a similar thought can be found in the original Our Back Endeavor paper as well. So they say that the appeal of the source-based tax depends on how high the rate is, and they add, it is quite possible that countries will wish to shift away from a high source-based cash flow tax, but not to eschew it entirely. And in my paper with Joachim English, we also had some kind of this notion of a complete switch from source-based tax to destination-based tax does not seem to be the optimal choice when hybrid systems are available. And actually, as you're from France and I'm from Germany, we already live in hybrid systems, right? We have a VAT, which is kind of a destination-based tax on corporate profits. At the same time, we have a source-based tax, right? All right, so then another comment is I was wondering whether this is a fair comparison. And so the critique, so it was easy for me to write this comment because I just had to look at the referee reports from my paper, and they apply to my paper as well. And so my paper with Joachim is subject to the same criticism. All right. So, but again, is this a fair comparison? So here's a reformulation of equation 1, which is the net profit of the multinational firm resident in the domestic country. And here's here you see that the source-based this variable S that kind of switches on the efficiency cost. So under destination based, the net profit is just 1 minus tau times pi. And once you have a source-based tax, you have this transfer pricing problem and concealment cost problem and so on. And the same can be shown for the tax revenue equation. And so tax revenue is just tau times pi. But if you are in a source-based tax system, then you have this transfer pricing things going on. And this gets me to my last comment. I think in my paper with Joachim, we have kind of a similar perspective. I was wondering how exactly your results to ours. Because we have a slightly different model, and I'm not saying we already did what you're doing now. It's just that it would be nice to see exactly how these two frameworks relate. Right? I think there are a lot of points in there that add to the existing literature. But again, so how does it relate? And I think, and again, this is a criticism that you can apply to my paper as well. And that relates to my second comment. Maybe there are behavioral distortions in a destination-based tax as well, right? So why not make it a fair comparison? We have a source-based tax, and this has some issues. And then now we consider destination-based tax, and there will be issues as well. And we know that because we have a VAT system, and for some reason, we do not want to finance all of our government budget by VAT taxes, right? So this is a bit of a far-reaching comment here. Maybe this is not for this paper, but I think this would be an interesting perspective to have something of a genuine trade-off going on. All right, that's it. Thanks.
Thank you very much. Before I ask the author to respond, would anybody else like to voice any further questions, comments on the paper? You can choose to speak your comments or type them into the chat box. Either of those options are available. No? Okay, so then would you like to respond,
Well, first, thank you, Johannes, for your comments. I agree that what should be interesting is to study the question of a hybrid system, because it makes more sense than just either choosing between source-based or just destination-based taxes. Yes, it makes much more sense, and this is what's being discussed, obviously, in many countries. Regarding the behavioral distortions under destination-based taxes is also a good idea, which would help explain why no one has actually decided to proceed forward with moving to destination-based taxes, even though this seems like a good idea when the debate started a couple of years ago. So yeah, I don't have a definitive answer here because it's something I will have to actually look into, but this is a very good comment, and yeah, thank you.
Great, thank you. I just wanted to add one sentence, which is if you're looking at a government trying to define its bouquet of taxes, trying to put everything as destination-based tax or as source-based seems sort of like Becca was just mentioning. If you have a VAT which is destination-based tax, I wouldn't know why you want a corporate tax also to be a destination-based tax and miss out on some of the base. So that's just a layman's response. Yeah. Thank you very much. Let's move on to the next paper. I think we're all enjoying ourselves, but we are sort of shooting a little over into time. There is a comment from somebody to whom I'll just respond, but Dr. Becker, would you like to start now?
Yes. You see this, right?
Yeah.
Okay. Good. So this is a paper in second best source-based taxation of multinational firms. Okay. So I'll make it very quick, the motivation. So you all know that there's a lot of things going on, talks about international business tax reform. And as an opportunity to ask a very fundamental question and to ask what is the optimal source tax on multinational firms. And you would guess that this is a well-researched question. But if you turn to economic theory, it quickly becomes awkward. Why? Because so the fundamental theory gives a very mixed picture as a starting point. So for instance, it says, well, in terms of capital taxation, don't do it. Right? We have strong theorems that say we shouldn't tax capital at all. With regard to capital taxation at source, we have the production efficiency theorem that tells us, well, we shouldn't do that if source taxes differ. And the Golden 86 paper tells us that the incidence of source-based capital taxes is on the immobile factor, that means labor, anyway. But at the same time, the Diamond Release paper says, well, you can tax profit at 100%. So don't tax capital, tax profit at 100%. This is not really good guidance for optimal taxes. And it doesn't get better so much if we look at closer at the applied theory to tax competition. So the classical tax competition literature starts with the assumption that we tax capital or property due to the lack of better instruments. Okay, so they explicitly assume we do not have hat taxes, so we need to tax property with a unit tax. That's the starting point. And there are other papers that say, okay, if you can identify pure profits, you should do so and tax them at 100%. If you cannot identify them properly, then some capital taxation is optimal. So if firms are mobile, tax location rents and so on. So a common theme in this literature, and this is, if you will, this is the main takeaway point. A common theme is in all these papers, there's usually a better instrument that is ruled out by assumption. So usually you look at these model frameworks and you may ask, why is there not a lump sum tax? And the paper says, okay, lump sum taxes are ruled out. Okay, so what I think we do need in the corporate tax or business tax literature is a model in which source-based taxes are the outcome of some optimization and not the starting point as an assumption. Okay, so we need to choose out of a large set of instruments, and source-based taxes are the optimum choice. And in this way, problems must not have an easy fix. That means if we shouldn't be able to say, okay, if we had lump sum taxes, well, okay, then that's easy. But we do not have them. Why not? Well, we assume to do so. Yeah? And in such a framework, we could then evaluate reform proposals. So you all already understood what I'm heading at. It's what I'm actually envious of the personal income tax literature, the personal income tax literature has the Merle's model, and that gives us everything we want. We do not have that for business tax. So what I'm doing now is to translate the Merle's model into the business tax world. Okay, so here's the paper's ingredients. I look at a continuum of firms with unobservable profitability that has been used before, but in more narrow contexts. Firms use mobile capital, which is, I think, standard, and shift profits to tax havens, which is standard as well. And then I assume that source locations provide public inputs. And so in later parts of the analysis, this will justify taxation, okay? And then in the second step, I add firm mobility, and so most importantly, source locations have an unrestricted instrument set. Okay, so if they want to use lump sum taxes, they can. They can use any nonlinear tax on everything they can observe. Okay, and residence taxes are. So here's the finding. The findings. So the first step is not surprising. So if I can observe types, then the optimal tax is type dependent lump sum taxes. Yeah, and the first best is achieved. Okay, but this is also true if we rule out profit shifting. Even with mobile capital, I can achieve the first best when true profit is observable and true profit can be taxed, and in principle at 100%. This is also well established in the literature. So here's the novel point. So what are second best source taxes? That means if true profit is not observable, then the second best source taxes unavoidably distort market entry, capital inputs, and profit reporting, and more or less as a consequence, public inputs are inefficiently low. I then add the sufficient statistics approach. I consider foreign firm ownership, type-dependent profit shifting, and firm mobility, as I just said. So here's the setup. So as simple as possible. So very easy, simple M&E structure with only two affiliates, a production entity that uses capital and public K and G that is located in what I call a source country, and then an E entity that is located in a tax haven. The tax haven is has low tax rate or zero tax rates. The production entity has a profit that depends on K, G, and theta. Can you see my mouse here?
Yeah. Yeah.
And this productivity parameter theta is private information and is normalized without loss of generality to be negative. It is distributed at an interval between theta lower bar and theta upper bar. There's a density that is derived from accumulated distribution function. As I said, the source location provides an input at a cost that depends on the level of the input G and the number of firms that enter the market. So that may be not important, but I allow for a congestion cost. I may simplify that and just say that the derivative with respect to n is 0, and in for many results that doesn't play a role. Okay, so here n is defined as 1 minus f of theta lower bar t, and this is the threshold at which firms enter the market. And of course, they levy taxes. So here's profit shifting. So a firm reports a profit pi hat to the source country, and the remainder is reported to the tax haven. That means there is no opportunity for tax evasion. That means all profit must be reported somewhere. Okay? And there's a concealment cost kappa that is convex, the difference between the true profit and the reported profit. That means the true profit should be reported in the production country. In the tax haven, there's no profit to be reported if the firms were honest. This is just a question of normalization. Okay, this is so that the IP has no income is not important. Then the firm optimizes over capital inputs and delta. Delta is the difference, as I said, between true profits and reported. Okay, and this is the gross profit, concealment cost, taxes in the production location, taxes in the haven. All this is not very novel in that way. So in the first order conditions are so the first derivative with respect to K equals the tax cost, marginal tax on capital adjusted for profit, and the first order condition with respect to profit shifting depends on the tax differential in marginal tax rates. Okay. Then the timing is, I start with considering revenue maximization. That means revenue net of provision cost. So the source country chooses a tax function and the public inputs, and then the firm decides to enter the market or not. That means market entry or outside, not off, and decides on the reported profit and on capital inputs. And all this is again, right? So first the institutions, then the firm decisions. So the first best allocation, I give you just the informal account here, as you can imagine. Undistorted capital demand, truthful profit reporting, the minimum profit equals congestion cost. If this weren't the case, you could drive out a firm and save some cost. Efficient public input provision, and all this can be implemented if types are observable. If I had access to type-dependent lump sum taxes, then this would not be a problem. Then we would have the perfect source-based tax system, and we would achieve the first best. The first insight is, again, not that big insight, but if I shut down the profit shifting level, I can actually observe types. I can make capital inputs tax deductible. That means have an investment neutral tax system. Then I observe true profits. I can tax them, without distorting profit generation, and therefore I can achieve the first best. And this is actually what the literature has shown. If firms are immobile, if there's only mobile capital, I am able to tax profit without, and Hans-Werner Sinn called this, our country can immunize itself against tax competition. So this is just so, and here the Gordon paper again. It's on the slide. Okay, so this is now the, I think, interesting part. So if I now assume that profits are not observable, what can a country do? It may levy lump sum taxes and some tax that conditions on everything that is observable. And by assumption, there are two things: reported profit and capital gains. That means the government optimizes by implementing a tax function that consists of some tax element and some tax conditioning on pi hat and k, and it chooses the level of public inputs. And this can be, if you're familiar with the mechanism design, this can be reframed using the inflation principle as, well, asking the firm to reveal its type, and then offering the firm an allocation consisting of everything: market entry decision, capital input, reported profit, and so on. And of course, the mechanism must make sure that the firm has an incentive or must not have an incentive to lie about its type. And this is reflected in the incentive compatibility constraint. This is close to the personal income tax literature. That means the net profit must increase in the type. And this is of course subject to a participation constraint. We have an outside option where firms are able to earn a net profit of pi o. Okay, I think so this is the properties of the second best source-based taxes. These are the optimal marginal tax rates on reported profit and on capital. And here you can see this is based on demographics. Yeah. So this is a term familiar from the personal income tax literature. And then you have here something that that's for the optimal tax on marginal tax on reported profit that is clearly positive. And here for the marginal tax on capital, that depends on how capital affects the incentive compatibility constraint. If capital increases, the slope of the true profit in type. And well, it may go both ways. It may be that capital is complementary to the type. Yeah, if more capital intensive firms are respond to the type more strongly, or the other way around, capital may be a substitute for the productivity parameter, which is the type. Yeah, the type may be the IP. Yeah, and then physical capital may be just a substitute. So more capital intensive firms may have less theta. So it may go both ways. So and therefore the marginal tax on capital may be positive or negative or zero. Then there's a lump sum tax element, and here you can see again that this lump sum tax element covers the congestion cost, but in the second best tax is even larger than that. And that makes sense. Why? Because there's an efficiency cost from taxing reported profits and capital. And by increasing the lump sum tax element, you gain revenue. This allows you to reduce the efficiency cost at these two margins, but you drive out some firms. Yeah? And therefore this efficiency cost is equalized, and therefore the lump sum tax element is even larger than under the first best. So there are less firms number than under the first best. And public's inputs are provided according to this equation. And here you can see again that this depends on how the public input affects the incentive compatibility constraint. So if it's complementary to type, then public inputs are reduced to make taxation easier. Yeah, so there's a distortion in order to to increase efficiency of taxation elsewhere. Yeah, but it can be completely unrelated. The public input can be of value for all firms at the same rate, and then it is actually efficient. It may be driven down by through the channel of the capital stocks, or maybe a substitute. That means firms that are not that productive do depend more on public inputs, and then it's subsidized. All this is can be learned from this first. Anyway, how much time is left? Sorry, I've lost track.
We are sort of running to the end of your 20 minutes. So.
Okay. So then let me just go through the remainder of what is this. It's a big paper. So it's then I have a couple of extensions. I consider national welfare maximization, foreign firm ownership, type-dependent profit shifting, and I apply the sufficient statistics approach. I will not cover that here. In the second part of the paper, I consider mobile firms. That means I add another margin of behavior, which is the decision to enter the market or move to another country. I do this in 2 steps. I consider a more attractive outside option. And here I show that this actually reduces welfare, or the welfare impact is less than the increase in profit for the firms that choose the outside. Yeah. So in other words, taxing the outside option increases welfare. Reducing mobility in that sense increases welfare, and that I provide an intuition bias. I skip this. And this is my last point here. Then I use a method proposed by Lehman and co-authors in their 2014 QJE paper. I consider heterogeneity in mobility costs. That means I assume a continuum of mobility costs for each type. That means we have a leakage of firms for any small policy variable variation. This gives us adjusted marginal tax rates. And this is actually the same. These are just adjusted demographics. And then there is another term here, which is the average tax revenue weighted migration semi-elasticity. And you see this reduces tax rates, which is intuitive because it's there's another source of efficiency. And then you can show that the tax rates and public inputs are lower, and in the competitive, in the symmetric tax and. Okay, I think I skipped the summary, just a restatement of what I said earlier. If you don't like what I propose as an answer, I would at least convince you from the question, or what I want to do is that we need a model framework where corporate taxes are an equilibrium choice if we have an unrestricted policy instrument set. Yeah, I think this is important to do serious theory work in that area, and that's it. Thank you very much.
Thank you very much. I'd like to call the discussant to give her comments now. Esmeralda?
Hi, can you hear me?
Yeah.
Yeah, just a second.
Sure.
Now you can see my slides, right?
Yeah.
Yeah, good. Thank you, Johannes, for the interesting presentation. So I'm going to comment this paper, second best source-based taxation of multinational firms now. Oh, so to briefly summarize the paper asks the question, what is the optimal source tax for multinational firms? This paper tries to answer the question by offering a model with a continuum of multinationals that differ in their productivity types. These multinationals use mobile capital, may shift profit to tax havens, and may migrate to other locations. There are also source countries in the model, and these source countries tax firms and provide public inputs, and from these public inputs, the multinationals may benefit from. The main results of the paper or the model are that if the multinational productivity types are unobservable, then the optimum source-based tax is a small lump sum tax and positive marginal taxes on reported profits and capital inputs. The paper also includes many extensions, for example, the heterogeneous mobility costs, but in the interest of time, I will go deeper into those. And just to briefly introduce the main advantages of the paper from my point of view, first of all, the research question itself is very interesting and timely, as there are, for example, discussions in the OECD on how to tax multinationals in an optimal way. The model seems to be very flexible to analyzing different applications, and there seems to be room in the literature for a paper like this. Then a few more specific comments. I especially liked the examples of applications you provided in section 3.3, for example, showing that the optimum tax is proportional tax on profit when assuming Pareto distribution and no capital inputs. This gives the reader an idea of the results. And lastly, I really liked the presentation of optimal marginal tax rates for capital and reported profits. This section includes some nice discussion, and the comparison to Merle's 71 income taxation was very good and gave the reader an idea on how to interpret the results. Then my comments, I will focus on the high-level comments that I think would improve the readability of this paper, as I felt it a little bit hard to follow when you are not that familiar with the previous literature on this subject. First of all, the current version of the paper is very math heavy, and some parts seem to lack some intuition. So you just show a result of a math, and maybe it could be discussed more at parts. Also, the definitions and parameters could be defined more accurately, as this would ease the readability. I felt a little bit lost at some points. What was this parameter? Then section 3 is now very heavy and takes over half of the total pages of the study, and was by far the most difficult section to follow on. I was thinking that maybe there's some room for simplifications or cutting it to 2 parts or something like that. And importantly, I think more discussion and intuition about the derived results are needed, especially in the end, to show the reader why this model is important and how can we truly benefit from this. And finally, I'm looking forward to seeing this model applied to some real-life applications or situations, as you mentioned in the paper that this could be used to analyze anti-BEPS measures. So that would be nice add-on to see how it truly can be applied. Thank you.
Thank you very much. Is there anybody else who would like to pose a question to the author?
Well, I have one.
Sure, please.
You talked about the relationship to the capital taxation theory, saying that in the theory you don't have any tax on capital, but you don't have that at sort of infinite horizon, but in a quite long horizon, at first you have positive taxation. So how does the model relate to that kind of thing? Do you have like changes over time? I'm not a specialist of optimal corporate of optimal capital taxation, but I know that you have that in some model you have that change at some point, but in a really far horizon, during which the first part you have that positive taxation, positive tax rate.
Okay, thank you. There's one small comment I had, if I may chip in before I hand it over to Dr. Lekha. My question is more general, I think. It is not necessarily relevant to the context, but does it make sense to ask a question in a similar way about when a firm will choose to be a multinational? So starting with domestic firms, when will more firms start choosing to be multinational as against being just domestic firms? Because I guess that is one of the concerns of this whole discussion. So anybody else who would like to chip in with a question? I'm sorry, I should have waited for the others to finish asking. Okay, so I guess there is nobody else, so we'd like to hear you.
Yeah, let me start from the end. Yeah, that's of course a highly relevant question when the decision to become a multinational, and it's even worse than that. So one of the weaknesses of my model is that I assume production entities are really an entity and cannot be split or and this is for simplification, of course, but it is, of course, a crucial assumption, because if you have differentiating taxes on production entities, then you can, well, just
break them up. Yeah.
And this is, of course, a good argument against analysis, but then again, what we see in real life is kind of differentiating taxation. Right, so it doesn't seem to be the a reason to completely abandon. Otherwise, I would have to, and I think I will add this at some point in the paper, that so if they can costlessly split up or merge, then this gives me a restraint on what I can implement as a tax. This is another argument than what you say. So yeah, so what I could do, and I think this is, once I have established this kind of model for this simple framework, I think there are a lot of other questions that are interesting. Yeah. So when to become a multinational, and what is the incentive if there is a set of taxes on multinational firms? That is, of course, an interesting question, and we know from the empirical literature that it's the more productive firms that become multinational firms, and maybe there's some investment going on. Right, and I don't want to discourage this investment too much by implementing high or distorted tax. The same is true. So I assumed a fixed level of IP. Yeah, that is of course strong simplification. I could not only decide on when to become a multinational firm, but also how much to invest in IP in the first stage. The second stage, I could implement this. This one. All these are, well, interesting question for the future.
Absolutely,
but thank you very much for this idea. Yeah, Manon, you're absolutely right, and you're referring to the Straub warning paper that showed in there in the Chemney-Judd frameworks that actually that may not be true, that capital taxation is zero. This wasn't meant literally that the literature doesn't, of course, tell us that in any case don't tax capital. But if you start looking at business taxes as a backstop to capital taxation, then, well, you pretty quickly see that large literature that says, well, should you tax capital? And that is kind of, other than, so the personal income tax literature, that has a really strong intuition that we want to tax labor income. With capital income, that's a bit different. Yeah, we have these kind of awkward propositions. Tax everything, tax the whole wealth, and expropriate everyone. Tax. Have a wealth tax at 100%, and then a capital tax of 0. And that's not a good starting point for having some guidance. If some OECD guy or some guy from the Ministry of Finance asks me, how should we reform business taxation? I said, well, my theory tells me have a 100% wealth tax on everyone, and then continue with a 0 tax on capital. They say, yeah, we call you back. Thank you for your advice. Then they never call again. So yeah, but you're right. So and the literature gives us all kinds of reasons why to tax capital. I just wanted to demonstrate that this is not that easy, and we have this, and I think we need some better reference for stating that, okay, as the Merlis model says, we cannot get around this equity efficiency trade-off. We need, in the second best world, we need to distort labor income, and I think we could make the same point for business taxation. Yeah, finally, Marika, thank you very much. You have a very good intuition about the state of my paper. This is exactly what I see as well. So the readability and to make it a bit more accessible. So this worked on this for a long time, and I think you can see still the ruins of former approaches in there. And yeah, sorry, I guess that wasn't an easy read, and I will work over the summer to be a bit better readable. Applications, real life applications, that is a nice idea, but it turns out that it's not that easy. And that easy to do this on 1 or 2 pages, as the model is quite, there's a lot of moving parts, and I think I've got an idea how to at least implement a minimum tax and to get some into it. I think that would be desirable. But yeah, thanks again for all the comments. Yeah, good. I'm done. Thanks.
Thank you very much. We'll move on to the third paper. Marika, would you like to take on the presentation?
Okay, so now you can see my slides, right?
Yeah.
Yeah, good. So I'm going to talk to you today about my paper called Profit Shifting of Multinational Enterprises, Evidence from the Nordics. So first of all, to briefly remind you, profit shifting is a way that multinationals react to tax policies and tax differentials in an international environment. The ultimate goal of profit shifting is for the multinational to minimize its global tax liability by moving profits from high tax countries to low tax countries. And this way a larger share of the multinational's profits is taxed with a lower tax rate. The main channels of profit shifting are transfer pricing, debt shifting, and the location of IPs. To briefly further motivate this research question, profit shifting has many acknowledged adverse effects. First of all, according to an estimate by OECD, the lost global yearly tax revenues are around 4 to 10% of total corporate income tax revenues. Additionally, high tax countries lose tax revenues to low tax countries, and this estimated tax revenue loss in the Nordics is around 8 to 13%, according to Torslov et al. Also, locally operating firms may face some competitive disadvantage since they cannot shift their profits and that way reduce their tax liability. Multinationals themselves also may be harmed by profit shifting since it may cause them some reputational costs if, for example, the profit shifting behavior is taken upon by the media. Finally, profit shifting gives some incentives for countries to compete with their tax rates in order to lure these multinational profits into their country. Then why study profit shifting, especially in the Nordic countries? First of all, there is very little evidence of profit shifting done by Nordic multinationals, so we know very little about them. Additionally, due to globalization, profit shifting is seen as an increasing problem as firms are more and more often multinational. This is especially relevant in the Nordic context as, according to Huizinga and Leivan, EU's single free market, and euro gives some additional opportunities for multinationals to shift their profits. From these Nordic countries, Denmark, Finland, and Sweden are part of EU, and Finland has euro as its currency. Finally, from this picture, you can see that all of these 4 Nordic countries have changed their tax rate during the sample period of 2012 to 2017. This gives some additional consideration to studying these countries. Finally, please note that whenever I refer to Nordic countries, I mean these 4 largest ones, so Denmark, Finland, Norway, and Sweden, as Iceland had to be excluded from the study because of so limited observations. So briefly about the model I use the very basic model introduced by Heinz and Rice in '94, where they assume that the pre-tax profits of an affiliate is the sum of its true profits and shifted profits. So the true profits is the part of profits that has been generated from real activity of the affiliate. And this is assumed to be produced by using capital and labor inputs with a given productivity level. So in this equation form, you can see that this part is the true profits, so labor and capital inputs and the productivity level. Then, according to the model, any part that isn't accounted to being generated by this real activity is seen as the part of profits that have been shifted into or out of the affiliate. And this part has been proxied with a tax rate or tax difference variable, since it is seen that the tax rate or tax difference represents the tax incentive to move profits either in or out of the affiliate. Additionally, I add some subsidiary level controls, subsidiary level fixed effects, as well as time fixed effects. So, as said, shifted profits is the part of profits that have been either shifted in or out of the affiliate, and this part is assumed to be positive in a low tax country affiliate as profits have been shifted into that affiliate, and vice versa for the high tax country affiliate as profits should be shifted out of there according to the theory. And as you saw, the specification was a log linear one. So the coefficient of tax rate or tax difference is interpreted as a semi-elasticity, meaning that the coefficient represents the percentage change in affiliates' pre-tax profit when tax rates change by a percentage point, keeping all else equal, of course. So, to briefly introduce you my main results before diving deeper into the data, studying Nordic multinationals as one sample results in semi-elasticity estimates between -0.8 and -1.2. These suggest that a 10 percentage point tax rate increase is related to profit before tax increasing by 8 to 12%. So, for example, if the foreign country increases its tax rate from 15% to 25%, the affiliate located there decreases its reported profit before tax by 8 to 12%. So, the data. I use a PANA data of foreign subsidiaries of Nordic multinationals for years 2012 to 2017. A foreign subsidiary has an ultimate owner located in one of those Nordic countries, and the ultimate owner must own at least 50.01% of the foreign affiliate. This results in nearly 14,000 subsidiaries observed for 4.3 years on average. The firm-level data is retrieved from Orbis provided by Burrell van Dijk, and from there I get information on ownership, pre-tax profits, capital and labor inputs, affiliate level controls. Then the corporate income tax rates are provided by KPMG, and as an alternative tax proxy, I use the average effective tax rates for year 2017, which are then provided by OECD. Finally, the GDP per capita is used to proxy for the productivity level of a country, and the GDP per capita is retrieved from World Bank. So here are the main regression results I already briefly introduced you to. So all the regressions include fixed effects at the subsidiary and time level. Columns 1 and 2 do not include additional firm controls, whereas columns 3 and 4 include also additional firm controls. The dependent variable is the log of profit before tax. So here I use profit before tax as the pre-tax profit proxy. I have circled the semi-elasticity estimates, so the coefficient of main interest. And as you can see, I do the regressions using tax rate and tax difference to ultimate owner as the tax proxy or tax incentive proxy, as according to some literature, this tax difference to ultimate owner should proxy the tax incentive in a more accurate way. So as you can see, all of the semi-elasticity estimates are negative, and most of them are statistically significant, suggesting that the foreign subsidiaries decrease their reported profit before tax in response to increases in tax rate or tax difference. So here you can see similar regressions, but with using EBIT as the pre-tax profit proxy, so earnings before interest and taxes. This is just to see if my chosen pre-tax profit proxy is driving the results. As you can see, again, the semi-elasticity estimates are all negative and most of them are statistically significant. So, and quite similar sized to the ones with profit before tax as the dependent variable. So giving support to my main results. Then I decompose the sample by the country of ultimate owner. So for example, this first column includes those subsidiaries that have the ultimate owner located in Denmark. This is done to see if there are any differences between the countries. As you can see, there are a bit small differences since Denmark and Finland receive statistically significant and negative estimates, and the Finnish one is actually quite negative compared also to the previous results. So just to briefly conclude from these additional regressions, by using the alternative pre-tax profit proxy EBIT, I receive semi-elasticity estimates between -0.8 and -1.3. Some of these estimates are actually a bit more negative than with profit before tax, and this is not what would be actually expected since EBIT excludes the debt shifting channel, whereas profit before tax should include all channels of profit shifting. So according to theory, the results with EBIT should be slightly less negative. And by comparing these semi-elasticity estimates received from the regressions with EBIT to those received with profit before tax as the dependent variable, we can see how important debt shifting is as a channel of total profit shifting. Doing this to the results where I have included the controls suggests that debt shifting as a channel accounts to about 18% of total profit shifting. Then with subsidiaries decomposed by country of ultimate owner, those with an ultimate owner located in Finland and Denmark and Sweden result in negative semi-elasticity estimates, though the statistical significance varies between those countries. Then I do a bunch of additional regressions. I don't have time to go through these, but just to show you that I have here a graph where I have plotted the coefficient point estimates of the tax difference and the 95% confidence intervals. And as you can see, all of the semi-elasticity estimates are negative, and most of them do not include 0 in the 95% confidence interval, giving some support to my main results. So then some limitations of the study. First of all, as argued by Huizinga and Leivan, the tax policy may be endogenous to pre-tax profits. This is since countries may implement some counter-cyclical tax policy where they raise their corporate income tax rate in response to seeing higher profits at peaks of business cycles. Additionally, a country with a higher tax rate may be able to provide a higher infrastructure, which on the other hand may enable the firms to report and produce higher profits. Also, using the statutory tax rate may not capture all tax incentives of profit shifting, as countries also attract profits with other favorable rules like patent boxes. Using the average effective tax rate is an option for here, since it reflects the tax burden more accurately, but also using average effective tax rate has its problems, since it's related to economic cycles and the profits are used in its calculation process. However, I do the regressions with the average effective tax rate for 2017. So as you can see, those are quite similar to the ones with corporate income tax rates. So maybe not a problem here. Finally, the used data source has its problems, as Orbis relies on published financial information. So the data coverage varies from country to country. And this also results in the situation where tax haven observations are mostly missing. This is a problem since tax havens are often seen as the destinations of profit shifting. So actually my results may underestimate the true profit shifting behavior since it excludes these tax haven observations. Then to wrap up, my main semi-elasticity estimates suggest that a 10 percentage point tax rate increase is related to profit before tax decreasing by 8 to 12%. This is confirmed with a bunch of additional regressions, and these negative semi-elasticity estimates are in line with previous studies where they find semi-elasticity estimates between -0.8 and -1.4. Additionally, the results suggest that Finnish multinationals react more to tax changes compared to other Nordic multinationals, and actually Finnish multinationals also stand out when restricting to subsidiaries located in EU or Euro country, which may suggest that being part of EU or having Euro as its currency may bring some additional profit shifting opportunities. Thank you for listening, and please, any comments are welcome.
Thank you very much. Can I invite Suranjali to give her comments?
Thank you. Thank you, Marika. That's a lovely paper, very timely. And I think the main issue for most studies on international tax is now quantification of movement of money across jurisdictions. And what I find interesting, and you sort of say this is the shortcoming of your paper, but I think it's interesting because you left the mess of tax havens out of the paper. And what you're really asking is that, you know, what do European companies or the Nordic companies really do with, let's say, EU subsidiaries or other developed countries, perhaps? That's my guess. And elaborate on my comment a little later, but I think it's a good starting point. I think you revised some of your results, but I have a couple of questions, and I also actually sympathize with the lack of information, which I've also grappled with when I'm working on my own stuff. So first question is that you use GDP per capita as a proxy for productivity. I mean, I think it's a good measure of income or level of income or level of development, but maybe not productivity if you want to probably incorporate GDP by the gross fixed capital formation as an estimate. Perhaps that's useful. I know that you have a log linear specification. Did you at any point to sort of estimate the frontier of taxes being collected, in the sense the maximum that you could collect given the economic conditions? Have you experimented with the frontier analysis, any stochastic frontier model to sort of estimate? And the other thing that I read in your paper is that you've excluded negative values, right? And when I reach the end of the paper, it talks about moving off profits to the Nordics, and with the removal of negatives, would that sort of bias your results? The other thing that I observe is that there's not much difference between the semi-elasticities measured by whether you take AETR or you take the statutory tax rates. And I sort of go back and look at OECD's data, and I see that there's not much gap in those two values. And in fact, interestingly, the gap is the least for Finland. And that's where you find the most pronounced effect. So my question is that, is there something else in the tax law which is sort of driving this impact, or am I not reading your results correctly? Please do correct me on that. Cost of employees might include top level pay. Well, you can't do much about that. You find that labor, cost of employees leads to higher profits, which you say that is the contribution of labor. But would it be that it is actually the better profit attribution which results from, showing more employees in a particular jurisdiction? Just sort of like a question for you. And of course, in the case of, you sort of try to derive policy conclusions why a profit shift to the Nordics. So I would want you to sort of conjecture on what would be the way forward. So is it that the Nordics should raise their tax rates? And for Finland being part of Euro, do you think that any currency hedging effects are also captured by your estimates? I know a lot of questions, sorry for that, but thanks so much, Monica, for your presentation.
Thank you, Suranjali. Anybody else would like to chip in with some questions? Yeah, Dr. Becker.
Yes, thank you. So this is a nice paper, but I guess an issue may be that there's already lots of paper on this question. And there are already meta studies on 30-something, 40 studies on that. And so then a good question would be, how could you sell this, right? And so recent studies are very much focused on heterogeneity between firms with regard to the asset structure. So IP-dependent firms shift more profits than firms with less IP, and certain industries are more prone to profit shifting than others. I think you did some of those things in the paper. Maybe interesting to highlight this. There are non-linearities, so there's not much profit shifting between normal rate locations, and most of the profit shifting takes place between production locations and tax havens. So my proposal for your selling point could be, so you got this interesting result that Finland is more subject to profit shifting, or has more problems with profit shifting than the other Nordic countries. And what I think what you could do, and this would be an interesting result, is to ask, is there a Finland effect? Yeah. So how much of that can be explained by different industry structure, by different asset structures, by different enforcement policy, and is there something left if you implement all this? Is Finland really different, or is Finland only different in terms of the observables that we actually can explain? I think that this would at least sell good in Finland. So Yeah, I think that would be my main comment, that you need some spin, some specific story. There will not be much interest in the main coefficient that there's actually profit shifting going on. I think nobody's has doubts about that. But otherwise, great paper. I think there's not much work to do to get it even more interesting. Thanks.
Great. Anybody
Can I
else?
quickly add? Can I just quickly add?
Sure.
The other question that I had, Marika, is that you use a Cobb-Douglas specification, and as Johannes has sort of mentioned, that every industry functions differently, and if you have tech companies in there, that Cobb-Douglas may not really work well for you. And of course, the other thing that I thought would be an interesting spin on this would be to sort of look at where these subsidiaries are located. As in, so what are these bilateral relationships that are facilitating this? Is there any sort of bunching of with any particular jurisdiction, the relationship of subsidiary and parent? So that's the last comment that I made.
Great. Anybody else would like to chip in with a question?
Yes, I had one.
Sure.
You're using just the statutory tax rate of your in the country of the subsidiary, or just the difference between the subsidiary and the ultimate owner? And I was wondering whether you could just also use the average tax rate of the foreign affiliate of the group, like following the recent paper of Johannes and Kaur, where basically they're addressing this endogeneity by focusing only on foreign tax rate, so that it does not impact how firms behave in your country, and this could maybe help your identification in this case.
Great. So Marika, would you like to respond?
First of all, thank you for the great comments. Yeah, there is an issue of how to sell this because of the various already so much literature on this. But thanks for the good ideas. I will definitely dive deeper into those. And I was planning to actually do the Johannes and the average rate of the foreign subsidiaries. Yeah, there were so many questions that I'm a bit lost already. Sorry. Yeah, the negative values was the Johannes, and also has a model for this where he uses a bit of a different model. Also planning to try that to my data and see what comes out. Yeah. Thanks again.
Okay, great. Thank you very much. To move on to the last session for the day, Suranjali, would you like to start the presentation?
Yeah, sorry. I hope you can see my slides.
Yeah.
Perfect. So distracting away from the last couple of presentations, which focused on international tax and what's happening across countries, or just sort of a framework, I'm going to look at a core question on what factors influence the design or the structure of a firm's capital. And of course, theoretically, we all know that tax is one of them. And that would be the intent of this study as well, to sort of look at what influence tax can have on the design of capital structure for firms. So sort of quickly walking you through literature, and I won't spend much time on this, is that, of course, the first factor would be cost of capital. Any firm judging whether to pick up equity or debt from the market would look at the costs involved, which would be dividend or interest involved. And related to the cost of capital is, of course, the tax treatment. So whether dividends are taxed more heavily or debt is deductible from profits. These are questions which have been raised before. And of course, we have the classic Modigliani and Miller result, which says that if there weren't any taxes, capital would be agnostic to debt, that the debt bias that exists could in part be driven by the tax implication. Other than this, I think it's important to look beyond just taxes and look at factors that the firm thinks about while going to the market to issue equity or going to the bank and asking for loans. And I think one of the more widely explored reasons is the ownership structure. And way back in 1994, World Bank looked at this and found that in India there was an aversion to sort of go through equity markets because it dilutes control. And I also noted this for the recent times in the case of startups. And of course, there is the requirement to disclose to stock exchange all kinds of information which firms may not want to do and therefore stay out of the equity market. There has been some theoretical thinking about when would the company go to equity and debt, and so therefore there's a full stage of maturity sort of model that Myers looks at, saying that when a firm is small, it relies on retained earnings, and when the firm gets larger, goes to the bank, and then finally to the equity market. But of course, there are also regulatory changes that could be shocks to the system, which could sort of change the way the firm raises capital. And in this paper, I've sort of focused on the introduction of the insolvency and the bankruptcy regime in India, which I'll talk about in a bit. So, you're going to ask, why is this important? Well, this is important because in the last 1 year, there's been a great deal of thinking, at least in India, and I do not know for other markets, but there's been a great deal of thinking on whether there should be relaxation of norms related to public issue of equity. And, especially for stressed firms. I mean, that stressed firms are not defined at the moment in law as such, at least in SEBI's law, which is our securities market regulator. But that question was definitely raised. And that led me to think whether actually stressed firms go to the equity market at all. And while doing so, there are different factors, as I had shown in the earlier slide, that sort of interplay with this choice. And so therefore, I raise, I've written there 3, I'm sorry, there are 4 main issues, at least, that I'm looking at in this paper, which is A, corporate taxes. How do they influence the capital mix? What is the impact of ownership structure, whether closely held companies want to raise more equity? And I think 2, which are the distinguishing features of this paper, which are not as widely tried before, at least to my knowledge, are the introduction or the shock of a new regulatory regime. And second is to ask, where do stressed firms turn to when they are in trouble? Do they go to the equity market or do they go to the debt market? Fine. So assuming that my question is important to ask, what is the trend? So I want to lay the trend down before I sort of dive into the last sort of regression results. So what is the debt to equity ratio? What is the kind of leverage in India? And there have been studies before to show that there is a debt bias. In India, it ranks pretty high globally. But then the question that I ask is that what happens after the Insolvency and Bankruptcy Code was introduced in 2016? Just to give you a context, India did not have this framework before that. And winding up of a company took many, many years. The creditors could not enforce their rights. And after May 2016, things changed. And we look at this graph. It shows that there is a massive sort of deleverage. Massive, I would say, because you're looking at these large listed companies. So just a sort of short introduction of the data set that I'm using. It is a bunch of listed companies which report information regularly in the span of 2000 to 2020. And by regular, I mean 18 out of the 20 years they report information. So it's sort of a balanced panel that I'll be working with. And for these, you see this massive drop. Now, the other question to ask is there heterogeneity, right? Like, is the capital structure in India the same, or does it differ across firm size? My apologies for the jumble, but trying to represent different deciles of companies, as you see, the first 5 deciles definitely are more leveraged. And over the year, and after the 2016, you see a dip in the first 5 deciles. The others are relatively volatile. But what is interesting is that there's a convergence in the debt equity ratio towards the concluding years around 2009. So where do firms access debt, right? So it's not just about total debt, it's also about the composition of debt. And to all sort of tax experts, we look at the structure of this debt for deductibility, right? So this is the representation of what the composition of debt for these firms looks like. I mean, of course, banks are still a major source of finance, but the next in line is intercorporate loans. And there are interesting features about intercorporate loans, which of course I'll show you in a few seconds, but there has been a propensity for this to, while they're stable, there are some companies which have shown more than 65% of the intercorporate loans are actually intra-group. And these are 80 companies that are recognized as large companies in India, part of business group, and which have foreign operations. So here it is. I look at, whether intra-group loans assume greater significance for foreign companies versus Indian companies. And you see that after 2009, there was a slight dip, which could have been because of a crisis hit back in the retained profits. But then it goes back to its normal in excess of Indian firms. But there's a level correction for the Indian firms around 2010, which is interesting because this was observed elsewhere in other countries, but I still have to sort of look deeper into what may have been perhaps some regulatory change that pushed more intergroup loans in this period. Perhaps it's the 80 companies which decided to go global, because this is also a period of more M&As being undertaken by companies through their retained. So good. So we have a general sense of what the debt looked like, right? Now I want to move to the next sort of variable of interest, which is stress in a firm. And there are different methods by which you can estimate financial stress. I've listed them in the first pointer. But of course, all of these are subject to shortcomings. For example, ABI is a relative ranking, and since financial stress was our key variable of interest, we removed that from our analysis. Looked at Olson's score, which over-predicted firm financials and was not able to capture default, so rule that out. And F score is a score used for valuing firms. It's not particularly for looking at insolvency risks or financial stress. So we look at this, but we compare the Z score, which is traditionally used in literature for measuring financial stress, and compare that with F score. And we find that Z score predicts faster the risk of default. And if you look at the table produced in the paper, well, of course, I put up a cutoff date to 2016 or 2014, and we look at the prediction rate, and except for 2019, Z score predicts better. On the side this is the formula for the Z score. So we have this measure of financial stress, which we identify. And sort of the last question before we sort of dig into the results is that, can we say more stressed firms tend to issue more debt, right? So this is just a statistical sort of representation. And what I do find is that companies that go to the equity market tend to report a better Z score. Now, just to give you perspective, the Z score between, which is above 3 is considered great. Between 3 to 1.8 is a gray zone, and below 1.8 is actually, there's a risk of insolvency and default. So what we see is that companies going to the equity market actually are much more well-performing, and the corporate debt those going to the corporate debt market are actually the worst performing. And this doesn't come as a surprise where corporate debt market hasn't really picked up in India. But if you look at bank borrowing and foreign borrowings, they're sort of in the middle. So from all of this, I use two sort of specifications to ask, what will a firm do? Issue debt in a particular year, looking backwards on what its financials were and what its stress was, whether it's the group firm. And the second part to the question is whether it will be more leveraged, right? So this is the first sort of regression that I've run. Now, note that because we're all talking about tax today, the variable that I've used here is the corporate tax rate. Now, there might be interest that, we should have included a dividend tax rate, just to give you some sense that the dividend tax rate in India has gone through series of changes in the period that we take. And it's not just the rate, it is the way it's applied as well. So, it's impossible to do it within this paper, but definitely would be a great addition. But at the moment, I stick to corporate tax to say that, interest is deductible. And so therefore, is there a benefit of going for more debt? Now, if you look at the base group, which is I've taken pure borrowings, and, some of you may ask, why not just take equity? That is because the sample shrinks and does not allow me to estimate them very well. So I have used a logistic model to predict what sort of source of capital will a firm pick up, looking back at whether it's a closely held firm, what happens when these corporate taxes are higher, what happens when it performs better in terms of its financials, which is its debt score. Also controlling for the groups, as I said, there is great preference for intra-group loans. Also the interest in regulatory shift, which is the dummy for the introduction of insolvency and bankruptcy code, and of course, controlling for size. What I do find is that I also include debt equity in this because I sort of think of it as past dependency. Your ability to borrow next period is in some what happened in the previous period. So, so if you look at it, if you're extremely leveraged, you will tend to go for more borrowings, which is a little worrying given that we have a situation at our hand with the non-performing assets. These second result, which I find interesting, is that there is still the need to control. So if there are companies that are closely held with higher promoter shares, they would be less likely to sort of go for a mix of issue equity and borrow capital and move towards borrow capital. Corporate tax rate, classic result. We get that higher rates would create a debt bias. Groups tend to rely on loans and perhaps could be driven by what I showed you earlier, the ability to borrow between the group. And IBC led to the deleverage that we saw, and is statistically significant over here. So these are discrete choices, right? So this is to say, in looking back at all these variables, will you in the next period issue debt, or will you issue equity, or a combination, right? So here the comparison is between debt and equity. The next sort of estimate here, and I've sort of limited my reporting here, but more results are available on request, is again to use those variables and predict debt to equity. And what I find here is that corporate tax rate, higher corporate tax rate leads to the debt bias, which is reinforced here. All of the results sort of tie in with the previous discrete choice model to say that, the leverage tends to be higher, where it's in a group where after IBC decline, for companies with higher assets, they tend, which we showed in the decile groups, right? So there tends to be more leverage. And of course, if the company is reporting a better Z score, it tends to be less leverage. So I'm going to stop at that. I'm going to just sort of quickly summarize key takeaways of the paper. Do corporate taxes lead to debt bias? Yes, paper finds it does. Did the introduction of IBC reduce relative preference for debt? Yes, we saw that the dummy was significant. What is the relative preference among firms under financial stress? We see more for debt, which is like a loop for firms to be in. And do group companies rely more extensively on debt? Yes. So, so that's the end of my paper. Thank you.
Thank you. Thank you, Suranjali. Can I request Manon to present her comments?
Yes. Here, can you see the screen now?
Yeah.
Okay. So thank you, Suranjali, for your paper. I have a few comments. Let me start with the your research question, which is that you're trying to investigate the determinants of the capital structure of Indian firms, and you're using the introduction of the insolvency and bankruptcy code to investigate how this change made firm adjust their financing sources using over almost 3,000 listed firms, and you have a long panel, which is really nice, and it's almost balanced, so it's nice. My first comment will be that I think your presentation was on some level a little bit more clear than the paper. Mostly regarding how you frame the question and everything. I think that should be added to your introduction, but I'll come back to the paper afterwards. Regarding just more general comments, I think it could be interesting to have like just a short descriptive statistics table of your main variables, just so we know what kind of firms we're looking at. Because I mean, I'm not really familiar with Indian data, and so when you're saying I'm focusing on this over 2,000 listed firms, I have no idea who they are, if it's like very established firm, how like the number of subsidiaries. You're going to talk about at some point ownership, and I'd like to know exactly how much are foreign owned, just Indian owned, things like that. But I think it just a small table would be quite interesting. A little bit the same with the measure of stress. So you talked a little bit about it in your presentation. I know in the paper that you're explaining a little bit the different measure of stress, but I think you're focusing a lot on it's the F score or the D score, but then for the other measure of stress, we have less information on what are the pros and cons of those measures. And I think it could be interesting just so you say, okay, this is what I think is the strongest for this and this reason. And then the other measure of stress can be used just as robustness checks, and you just so we know why you specifically want to use one measure of stress and what's the advantage of it. And then regarding the insolvency and bankruptcy code, this is a little bit the same as my first comment. I didn't know what that was, and I think a little paragraph on what this is, what firms are tackled by this new law, things like that, just some context so that we know exactly why you're using that and how you could maybe use it for as part of your identification strategy. Then on the identification, I thought the way that you presented the paper here was more adapted. In the paper, you have a long part which is very descriptive with a lot of graphs, and then the regression and your results are really at the end, and you spend like a page and a half on it. And I think maybe you spend either too much sort of time on the first part, especially because I think sometimes the interpretation of the graph is not very obvious to me. like when you're saying you have some convergence in the debt equity ratio when you decompose it by decile, I struggle a little bit to see this convergence. And then I think the table regarding your result is interesting, but then I was a little bit sort of disappointed that the paper was ending right after, and I think you should maybe expand more this part. Next, regarding specifically, so this table, and so the last part that you just showed us, I was wondering why maybe you are using the thing, and I'm sorry if you do, and I think the paper needs more the paper needs more detail on your identification strategy and the equation you're estimating and things like that. But I was wondering whether you're not using fixed effect. Like I would, for example, think of industry or fixed effect so that you can, I'm guessing there are some differences between depending on whether you are in manufacturing or in finance or things like that. I would also control for age on foreign ownership. I think you're showing the graph on debt and whether it is within firm debt or intra-firm loan and things like that. And I think it could depend also on whether you're foreign owned or if you're Indian owned or domestic owned. And then I was also thinking of a proper difference in difference strategy. So you have that dummy for the insolvency and bankruptcy code. I was wondering whether you could specifically estimate the impact of the introduction of this code on the change of capital structure, because you're showing the graph, and I was wondering whether we could like see the proper results. I don't know if it's easy, if you could have like some sort of definitive strategy if this insolvency and bankruptcy code does not apply to some firm that you could maybe compare. That was one of my idea. And then coming back to the structure of the paper, so I think in mostly in the introduction needs some rewriting. I also don't know whether you're aiming at proper research publication or if it's also meant to be used to some policy work. So it maybe depend, but I think the research question was really well introduced in your presentation, and in the paper it comes quite late and it's not that very developed, and I think you would gain from precising the question and going a little bit more into detail. And you should like add some preview of your results and also the literature on the topic. You're specifying a little bit some of the main paper, but very, very briefly, and it's hard to know how it really relates to the current literature on this topic. But thank you, and I think it's nice to have some data also on developing countries and not only on like the US and European firms. So thank you.
Thank you. Thank you very much. Would anybody else like to add any questions for Suranjali? Okay. So Suranjali, would you like to respond?
Yeah, thanks. And I'll do this really quickly. Thank you so much for your comment. I think you've read it more thoroughly, and I admit to the swift writing that I've done. I've missed out quite a lot of things that you've raised. Just to sort of give you a sense of what these firms are, these are actually the largest listed companies, non-financial companies, and they account for about 70% of the sales reported in the data that is available to us. So maybe I should move that up a little bit. We did use fixed effects model. We got similar results. I was just worried about the standard errors, and therefore I moved to GLS. But of course, worth reporting that in a table with all the other results. Take your point on that. I did try to use foreign ownership, didn't find very much. We did control for age and perhaps should report that result where, what we get in that. And of course, perhaps can check out if I can use a DID strategy for what you're saying, and definitely rewrite the paper and then submit it. Thank you.
Thank you very much. I think it has been an interesting 2 hours. We were given an hour and a half, but we've stretched ourselves liberally. But thank you very much. Wonderful papers, and it's been a pleasure being here. Bye-bye.
Thank you.
Bye.
Bye.
Bye.